Hey Peter, can you hear me?
How's it going, Sean?
Perfect, perfect. Doing great. How are you?
Yeah, I'm doing good, man. Just a big spin type class. I think you do like a similar one where it's all on the screen and stuff. I saw it on your Instagram. It's good, man.
Oh yeah, nice, nice. Yeah, it's a great workout.
A lot of calories. Don't think I'm going to be able to sleep. I haven't trained late like this before, so I'm going to be in bed like rattling if I go to sleep, dude.
Yeah, I try to keep my workouts, way before bedtime because I'll be up all night.
Yeah. I thought I'd try something different. Probably going to regret it. Yeah, man. Thanks for the invite for the call as well. This is great.
Yeah, definitely, no problem. So today you wanted to cover basically, I guess, the V3s during London session, right?
Yeah, I mean, I've got some notes here, Sean. Shall I give you a really quick background on my experience? And then I've just got 5 points. I don't think it's even going to take that long that I'd like to cover and just get me on the right track with things, really.
Yeah, oh, definitely.
Yeah, I've been trading for about 18 months. I've done everything, tons of terrible courses, swing trading, everything. But I'd always have the most success when I take these tiny little pieces out the market. So I managed to get a 100K funded account trading US 30, and I was on the 15-minute time frame, very much working zone to zone. So like on the 15-minute, I'd draw a top, middle, bottom zone. I'd look for rejections and stuff like that. So I've learned some good stuff, which is helping me with this actually. So that's kind of where I was at. I was stuck at break even on that for a few weeks, and then I knew Matty in the group from another place where we met, like another course thing, and he told me about what you guys were up to. So I came into K2, I think about 3 weeks ago, and then the first thing you see is the group full of everyone sharing blue stuff, blue, and I thought, wow, man, these guys must be doing like everything. What's this liquidity thing? I need to do all this. So quickly lost a few percent, nothing out of control. And I had a word with myself last week and sort of, you mentioned on the call, focus on one thing. You were mentioning the guy who only traded the breakout. And I thought, right, what do I like the most here? I like the fact that a V3 is a one-to-one risk to reward. Because, when you're inexperienced, those ones that are 1 to 3 the wrong way round, you quickly burn through your through your account, right? So
Yeah, it's easy to get greedy with those because you'll win a lot, and then once you lose one, you'll keep doing the same
yeah,
mistakes, and then it'll just
yeah.
keep adding on from there.
Yeah, so I kind of had a word with myself at the end of last week, and I had a brilliant couple of days. I've found this new discipline, and luckily for me, I'm in the UK, so I'm able to do London and jump on the lives as well. So yesterday and today's been brilliant. I've won some trades. I felt very calm in them. I was still struggling closing them out early. But really, Sean, like what I'd like to do, I've done a lot of back testing at the weekend for V3s in the London session. Just in general, really, man, I've got like a few points here. I may as well just say them all and we can cover them. So the main thing is like, obviously there's like a 3-minute video which explains a V3 inside the content area of K2. But I guess like any trade, you're going to get higher quality V3s than lower quality. I know the K2 bias and stuff, but more I've been noticing like, I guess the candle prior to entry, the length of that candle, we say too big, but I'd like to know kind of how big is too big, when I should be recognizing that it's a V1 or a V2 and maybe avoiding it or just going for the 10 points. The relevance of pivots when looking at a V3, I've definitely noticed when it's respecting those two pivots that aren't the really messy ones and it's just like kissing those. I get some really nice ones when I'm going with good trend meter and with the points, and reading the higher time frames as well. And a bit of risk management. This is something I'd really like to go over, is if I'm in a V3, what key things should I look at to exit early and try and save my capital so it doesn't hit the stop loss? Like I've noticed when I've been in them and the high or the low shifts over to another candle, I've kind of thought, right, that doesn't seem right. Something's changed there, get out of it. So that's it really. And then like not taking V3s when price is overextended. So I guess just high quality V3s, the difference of really recognizing V1, V2, waiting for a good quality V3, the relevance of pivots, risk management. That's it. So just to focus on that. Like I say, I've definitely noticed in London, I've found the sweet spot is practically half 15 and 15 rather than 30 and 30. So that's it, man. That's it, really.
Yeah, no, definitely. Yeah, the volatility is a bit different during London, especially if you're trading US 30, since the asset is technically closed. But it is quicker than Asia session. So for the first part of your question, basically, when identifying how when a candle is too big, typically I would look at it. Let me see if I can find an example here. If there's a big candle, like something like this over here. Let me just go back. This would be a big candle if the candle prior to it wasn't too big. So you can see how these candles are very similar in size. These two right here. If it's something like that, then that's okay to take something like not that this is an entry, but I'm saying like if the candle prior to it is about the same size, and it's fine. An example of something that's too big would be something like this right here.
Just to confirm, Sean, by prior candle, you mean the one that would be at the high, or the one which closes just before you hit sell? Which one is the prior candle?
Yeah, it would be the one like right before, but you can take an average of like the past 5 candles. Like, so for example, right here, let me just go to this example. I know this isn't an entry, but I just want to show you like when the candles are a bit different. So like, for example, right here, this candle is, and you just measure the entire candle. This candle is about 370 pips, 37 points. If you measure the ones prior to it, you can see that these over here are generally like about half the size. Right. So you can see it's about like 1, 2, 3, 4, 5, 6. You can do an average of like 5 or 6 candles, and you can see how it's different because these candles here are a lot smaller compared to this one. So not that, well, technically this is an entry here if you're applying the pivot scalp strategy. I don't know if you've been applying that one, but this would technically be an entry. And if I was to enter this, I wouldn't enter immediately after. I would wait for it to pull back a little bit. You can see from this following candle, price kind of pulls back a bit right here. And what I would do is if I was to enter this, I would set a sell stop, or I would wait for it to come back down, and then I would make the entry as it drops further. So if I was to do that, I wouldn't enter right away, but when I'd enter late, you can see it goes straight to profit target from that point. So this is how I would measure, like if the candle is too big. So like, for example, this one's too big. So I wouldn't necessarily skip it. I would just wait for it to retrace up a little bit. Because typically when the candle is big like that, it will retrace either to the halfway mark or the full candle. So like
in this case, you'd only go for 100 pips, right? In this case, where it's a big candle, bigger than the previous 5, it looks unusually big compared to those. You take a safe bet and take 100 with a 300 stop loss.
So for this specific entry, this would be a pivot scalp entry. So for that, that's what the default TP stop loss would be. Let me see if I could find a V3 here. There's actually a V3 right here. So this is a V3 right here. I wouldn't necessarily say this is too big of a candle. So maybe this isn't the best example. Let me see if I can find one.
So obviously a V3, like, the V1's requirements is a double wick, isn't it? And V2's like a double body where they're in line. So a V3 would mean there'd be no equal length wicks and the body would not be in line with the body.
The V3 is actually the easiest one out of the 3 because you're not really looking for anything specific. You're just looking for an opposite candle. So for example, here, this would be a V3. So I'll just go over the requirements here. So for the V3, we confirm the overall bias. Obviously today there wasn't very much of an overall bias. It's a bit difficult to catch something that's quality per se. But if you were to skip that and just assume it was bearish, you would confirm the high low. We have the high right here. Confirm the high is a green candle for a sell. That's the green candle there. And then you just confirm the following candle is a red candle, just opposite. So if you're
So
looking
you've
for
accidentally taken a V1 or a V2 though, without knowing if it's
I've seen a lot of people who take them on accident. Like for example, right here, this looks like a V1, or it possibly could be. Let's see if I put a line there. Yeah, so this would technically be a V1 as well, because it is a double wick. So for the V1, it can be a double body or double wick. For the V2, you're looking for a strong. Actually, this qualifies as all three strategies. Yeah. So now that I think now that we reviewed it, yeah, this actually fits all the requirements because and if I see something like this, so if I see an entry like this is going to be very high probable because it's like multiple strategies aligned. It's basically like the triple confluence strategy. Have you looked at that strategy?
Well, Sean, I overwhelmed myself at the start and I started trying everything, spreading myself thin. And as soon as I only started looking at these, I've had a great couple of days with no losses, like an accidental loss this morning, but it's been good. So I'm just purely, I have a bit of an idea of what they all are, but I really want to laser in on this because I see them come up often and it suits my other mindset for reading price action on the 15-minute.
It aligns up because if you're doing like, basic price action, a lot of these patterns are basic price action patterns, right? It's just you're using the indicators to kind of, it's like a guideline basically. Because when you're reading price action, it's very subjective. Like what you see could be completely different from what I see. But since we have requirements here, you just line up the requirements. You're like, okay, this would be an entry for something like that. So for this entry right here, this actually aligns with all three strategies. For the V1, you're basically looking, everything has overall bias, everything you confirm the high low. The main difference with the V1 is you're looking for either a double body or a double wick. Right here, there is a double wick. So this would qualify as a V1. For a V2, this would also qualify for a V2. The main difference between V1 and V2 is that you're looking for an opposite candle with no wick on the bottom. So if you're looking for a sell, this red candle has to have no wick. If you're looking for a buy, you're looking for a low, and then the next candle is a green candle with no wick on the top side.
So for you, no wick on the bottom of a red candle means it's a strong red candle. It's not rejecting at all, right?
Yeah.
For me, I've learned like on the higher time frames, on the 30-minute and stuff, no wick means it doesn't want to carry on going in that direction on some of the stuff I've learned. So it's a bit of a mindset shift,
Yeah, exactly. So like for the V2, that's what you would be looking for. That's the main difference. For the V1, it's double wick, double body. V2, no wick at all. It's just a strong candle. It's just indicating that there's a lot of momentum going in that direction. And for the V3, you're not looking for any of those. The main difference for the V3 is it's basically a V2, but it doesn't need the requirement for a strong candle. It could be any weak, strong, any type of candle. But the main difference is the minimum stop loss. So for the V1, you can take it at any point, V2 take it at any point. But for the V3, in order for you to take this trade here, you would need a minimum of 300 pips, which 300 pips would be right there. And it's fine. You'd put it to the previous high right there, and then the equal distance away. And that would be a V3. So
I understand now. So what I don't want to do is accidentally take V1 and V2s and aim for 300 pips, right? And then I'm in the wrong move. And then I'm like, shit, now I'm in drawdown. I was up. And now I'm like, there's no way I'm going to get 100 pips now. So does that requirement of there being a minimum stop loss of that size kind of qualify that it's a strong candle that's going to give you 300?
Yeah, no, definitely. Yeah. So for this right here, if I was to see something like this, I would feel confident that it would push below because for one, it's a strong candle. So you're seeing a continuation of it. And then usually if it's a strong candle like this, and then there's, a pending signal, it's usually going to push through because the momentum just keeps pushing down. You can see another example of it right here. So here's it's not a very strong candle, but you can see there's a little wick. And then it's followed by a sell signal, which is a strong candle. And then even though there's a session right there, it still pushes, right through it. So these are like little patterns that you'll start to like notice. It's not something that like you really look for. It's just kind of something that's like an addition on top of the strategy. So like if you see a V3 here and you see that, the entry candle is a strong candle and there's no momentum, typically, the momentum is going to push at least 100 pips or so. So if you measure like any momentum candle, it almost guarantees that your V1 and V2 will hit because you're only going for, that much of a move there.
And out of the three, Sean, I see you get 100 pips very often. Is that more your go-to than hanging on for the full 300? Like, I see you always secure like a quick 100. Would you typically just aim for that and secure it, or would you think, right, now I need it?
So typically I don't really see too many V3s during the live session. It's like we'll see something where it's very close. Like, let me see, like this is an example right here. Let me go back to this point. This is an example of something where I would want to take a V3, but it doesn't fit the 300 pip requirement. So that's why I only go for 100 pips. If it doesn't fit the requirement, but it's close. So like, for example, right here. So for this, it's only about, 200 pips. If it looks like a good trade and I want to take it, then for something like this, or maybe this is a better example here. Let me measure this real quick. That's the same thing. So for something like this, you can still take the trade. Like, I know that there's a requirement there, but it's like a soft requirement. The requirement for the minimum stop loss is just so that you have some sort of cushion in case, the price retraces a little bit and then comes back down, kind of similar when there's a big candle. And that's the reason why we have the red flag for the candle is too big. So for this one, if the candle is too large, typically you want to wait for it to retrace a little bit before entering. But if you're taking that trade for a V3, you already have enough gap there, right? Like, there's going to be enough space there, even if it's a big candle. Because usually when you see a V3, not this one, but if you see a V3 here, I don't think we had any today. But generally, when you do see a V3, it's usually a red candle or a green candle, and it's usually a large candle.
Yeah.
So yeah, that's why you need the minimum of the 300 pips. But if I wanted to take something like this and it doesn't fit all the requirements and it looks like a good trade to me, say for example, the trend meter is red, it's below the pivots are spread out. I see that we have a strong bias for a sell, and I think price is going to come down. Well, in this instance, I would take the trade, but I would go for the 100 pips like you mentioned. Like, for example, right here, if it's, I wouldn't take this because it's so close to the sessions, but say for example, the sessions was a little lower, like, a little farther down. I just want to have that gap right there so that in case it hits the session, it'll hit my TP first and then it can reverse.
So I guess maybe because I spent a lot of time sitting through the morning today, really being patient, waiting for a V3. But I guess based on what you've said, if the trend meter is the correct color, there's a good bias. I mean, I should just be securing these little 100 points if everything looks good, shouldn't I?
Yeah. And that's what I do sometimes too. That's why sometimes I'll say, oh, this isn't an official trade, but I'm taking something speculative because it doesn't fit the requirements. But if the direction is very strong, because that's the real key, it's looking for a strong direction, like looking for bias. If you see a strong direction, like something like this, where, I could like list a couple things here. So things to confirm, strong bias or strong direction. You can look at pivots. How spread are the pivots? Because the wider the pivots are, you can see from here, like if you start from the top, let me see if I get, so you can see right here was crossing over a bit.
Yeah.
But then as soon as it started to spread out a lot more right here, and you can see everything is like, I can even hide the candles here. So if I hide the candles, you can see right here from the pivots when they're, let me just turn these off too. Yeah, you can see the pivots here. They're kind of crossing over, but once they start to spread out like they do right here, it starts to come down very heavily. And you can tie that in with the trend meter as well. This is like a way that I would trade before too. If I'm doing like long-term trading or scalping or swing trading, you can basically just identify when these start to spread out and when the trend meter is red, and you can like just ride the wave down, and then you can just move your stop loss right here. This is how I used to trade some Forex pairs. When I would see it move down, I just keep moving my stop loss down with it. And then as soon as it swings back up, that's where I would get pulled out. So there's different ways of applying these. I mean, all these tools I've created them for like specific reasons, like I was trying to identify the trend, and these are basically the same. They're the same tool. The pivots will identify the trend, but the trend meter will also identify the trend. So if you have two different tools using different types of data sets, and they're both indicating a strong downtrend, that will give you a bias. Like this would be perfect if you don't have a retail sentiment bias or a fundamental bias, basically like today. Like today was kind of difficult to find a bias because the fundamentals were going back and forth. and the retail sentiment was 50-50. So, your next step is to look at the trend. So yeah, if you find something like this where you can see it spread out, like for one pivots,
I've definitely noticed that, like, for sure. And when it seemed clean, and well, I actually have hidden the green and the yellow one, which are like kind of always tend to cross price more than the orange and red ones, which seem more smooth. Do you think that's a bad idea and I should turn all four on?
So I personally like to have all of them there because I can see when price rejects off the pivots. It kind of just gives you an understanding. Like, say, for example, if price is retracing here. So right here, you can see that the pivots are starting to spread out. You always want the red. This is one thing that you want to keep in mind. The red one always has to be on top. So because they're by levels. So right here, it looks like the pivots are spread, but they're not necessarily spread because the red is supposed to be on top. So for it to be a strong trend to the downside, you want the red on top because they're by levels. Green is level 1, yellow is level 2, orange is level 3, and red is level 4. So basically, when you're looking for this to spread to the downside, you can wait for it to cross like that, and then now you can see that the trend down is actually very strong because
I guess are these obviously the actual requirements for the strategy is simple, but would you ever consider that a red flag not to enter if the red wasn't on top of all the pivots and you're trying to ride something?
Yeah, you could. Well, I think a bigger red flag would be something like this when they're crossing over a lot.
Yeah,
I think that's where I would just avoid, trades and whatnot. Because you can see here, if you just rewind even further back, like right here, you can see where it's kind of crossing over a bit. And I can hide you can see how they're kind of crossing over
yeah,
a lot right here. But as soon as they start to spread out,
yes,
right there, you can see it's spread out now at this point. You can see that it's on its way down. And then you can use a trend meter as another confluence because you can see here it changes from green because it was trending to the upside. Right here was a consolidation. And then now that it's shifted over, now you can basically take, whatever V3s, V1s, any type of trades that you're looking for. And if I turn this on here, you can see that price is starting to drop even further.
Really good stuff. Yeah, this is great.
Yeah, these tools, like I use them all in conjunction. I know they're not listed in the requirements, but for me personally, like everything here helps. Like, the more tools you have, the more confirmations you have, the better. Like, for example, I use the pivots to identify the trend. I use the trend meter to identify the trend. I use the high lows or the session high lows to identify, where to maybe avoid trades around this area. And there's a couple other ones that you can use too. There's a K2SR. I don't know if you played around with this. Have you played around with this indicator before, the SR version 2?
I noticed you didn't use it, so I kind of kept it to the core ones that I see on the live. So I haven't played around with that one, no.
Yeah, it just makes the chart a little messy, but I mean, if it can also be used as a good tool because it just automatically plots the support and resistance on the chart. So like, for example, if you have the resistance plot on the chart like that, you can kind of see where price is, where it's going to come back down. Like if you're looking for a retracement and you're waiting for it to come back down, you can use that. But if you know how to, plot your own support resistance, you can do that as well.
Yeah, I've been doing that already, and it's actually, I've been marking it up on the 15, and it's kind of really respects it on the 1 minute. I've never looked at the 1 minute chart until I started K2. So today I was like, wow, this is really helping, like seeing it at resistance and then closing back under when it's done the fake push and stuff. So it's pretty cool using those as well, definitely.
Yeah, definitely. That's what Kevin does actually. So you've seen Kevin's profits. He basically catches the bounces. So like what he does is he'll go on the 15-minute, and then he will draw his resistance and stuff like that, and then he'll wait for it to come up and bounce off those points. So he's basically taking shortcuts within the strategies, but it's okay for him because he knows what he's doing. I don't really teach people how to do this because it's more of an advanced way to trade, and you kind of understand it as well. So this is something that, you can use to your own advantage. Like, so I drew this resistance on the 15-minute, and you can see where price respects it very well. Because it breaks above it, and then now it creates this as the support.
Yeah, definitely, Sean. So, yeah, man, I've learned so much here in a very short period of time. This is super good. So we've covered almost everything. I guess I guess the last kind of two things I've got a question on are risk management, as in preserving capital when you think, right, this isn't
Yeah.
going how I planned. So obviously with the 100, well, I guess with any V1, 2 or 3, at what point would you think, because I've noticed some people's who do a lot of trades, is very impressive in the group. They'll have decent-ish size wins and then very small losses. So what's kind of what would you consider any reasons or red flags when you're in a trade to think, right, this hasn't pushed down, it now looks like it's going the wrong way, get
Yeah.
out?
Yeah, the main way for me to identify something like that is when I have the sessions on. So the sessions are like a big help. The sessions, the news price. I'm not sure if you draw the news price as well. News
Oh,
price.
absolutely, yeah, definitely.
Yeah.
Opening, everything. I've also noticed, Sean, as well, sorry, just one thing that I've noticed from sitting through two sessions, when you leave the London open, the one which is midnight PST, you know, I think it's London, I don't know what it is. When I've left that on the screen and come back in New York, it treats that like structure as well, you know, it'll bounce off it and stuff. The actual London open from midnight your time. I've noticed that yesterday.
Yeah, yeah, it happens a lot. That's why I like a lot. That's why I created this indicator, the sessions high low, because it does respect it very much. You can even, what I've seen some people do as well is they draw these sessions from the previous day and then they just leave the line up. I don't do it myself because I don't like having a messy chart, but I've seen other people do that as well. And it does respect it like the following day or the opening price from yesterday. Usually if the price is still in that range, it'll
Really?
respect it at that point too.
Wow, it's like it's never ending with the stuff that keeps happening, isn't it? You think, how far back do I go? Next
Yeah,
thing
yeah.
I'm looking at loads.
Yeah, exactly. It's a pattern, right? So the thing
Yeah.
with US 30 that I like is that the patterns always repeat. So like you know, whenever you draw the previous high lows from the open price and close price, or even open price, close price from different sessions, it typically respects it. The good thing with the 1 minute is that since we're going for small moves, we don't tend to get like price doesn't tend to mess with our trade because we're only going for 100 pips. So, you know, or for most 1 minute trades. So the 100 pips is like, you know, it's very minimal. So you can get in and out of trades without getting caught in these sessions. Like, for example, if you're looking for a sell here and you have some sort of variation and whatnot, you can enter trades before getting to those points or before getting stuck in those points. Like if you're trading on the higher time frame, like the 10-minute, you may be going for, you know, a bigger move, maybe 700 pips or 900 pips. And then once you do that, it becomes more of an issue because you get so close to these sessions and whatnot.
With distance from sessions, I heard you answer someone's question yesterday, but just to touch on that a bit more. Let's say you were waiting for a buy, right? And, you know, distance away from the session, I guess, as like a threshold. And then when it closes over the session, would you consider it then safe? Or is it just near on either side? It's no good. It's going to mess around and fake out over it and stuff.
Yeah. So for me personally, I would make sure that it's at least, there's no like threshold specific number, but from my experience, like measuring it, it seems to be like around like 200 to 250 pips away. So like, for example, right here, you can see that I drew 250 pips that way and 200, oops, wrong tool, 250 pips this way. You can see like when price does come around this point, let me just go back. So when price is bouncing around these sessions right here, you can see how it kind of fakes out a bit. It'll close below, like you mentioned, and then it'll fake out to the top. So what happens here a lot of times, and I've seen a lot of people take trades like this, is they wait for price to break and close past it. And then what happens is when the price swings back up, they close their trade because they think, oh, you know, price is reversing on them. But it really just fakes out. It comes back up a little bit. And they think that, you know, price has reversed at that point, but realistically, it's just faking out. It comes down, fakes out again a second time, and then it just comes back down further. So basically, I try to keep it maybe around like 250 pips away, just because I don't want to get caught in these fake outs here. So for example, if I'm looking for a trade here for a sell, I would typically only enter it. Let's see if there's, so there was nothing here. Actually, there was one right here. So if I was to enter something like this, I would want this to be at least 250 pips away from there. because if you're going for 100 pips, you have to factor in the spread. Spread's typically around 110 pips during New York session. During Asia session, it's like 140 pips.
Yeah, it's 170
in London.
Yeah, so to compensate for that, I need to be going for what, like 12 points. I'm still getting used to saying points and pips.
Yeah, it's a bit confusing when you're comparing the two, but yeah, if you're going for 100 pips, you're going for that, and then on top of that,
is that right?
Yeah, for about 100, basically 270 pips.
So it's actually that 17 number it's like double what I'm going for. So say I was aiming for a V3 in London, which I saw, 150 pips looks good for a V3 from the back testing I've done. If the spread number that I see in MetaTrader is 17, does that equal 170 pips?
Yeah,
like more than my actual take. It's double my take profit plus more.
Yeah, exactly. And that's why I usually go for 100 pips, because I need to cover the spread on top of that. Because I'm sure you've noticed whenever you take a trade, you're already automatically in negative, and you don't make profit until you've reached the 100 pip threshold or whatnot for the spread. Once you've covered the spread, then it'll be profit from there.
So you get in late kind of thing, and then it moves past your entry. It's not like you have to go further than you take profit. I get
Exactly. Or sometimes, like when you enter a trade and it retraces and it comes back down, that's where you'll cover the spread. So like sometimes you'll be in a trade, it'll retrace, and then it pulls back in, and you're like, okay, you're back in profit. And then from there, it's where you're actually making the move.
Wow, man, I can't believe I didn't know that. That's interesting. I guess you don't think about these things when you're trading on a 15-minute time frame,
Yeah, because the price is moving up and down so often, where you're going to cover the spread eventually.
So yeah, I don't need to extend the actual the amount. What I was doing was adding on more pips to my take profit to think that I was having to move further to compensate for the spread, but in reality, it just takes more time to catch up, basically.
Exactly. Yeah. And if you want to just cover it, you can also subtract the move. Like say, for example, you mentioned 150 pips for your TP. If you want to cover the spread or cover half of it, you can just go for 100 pips instead, so that you can just kind of minimize the distance that you have to.
Yeah, the distance. That's interesting.
Yeah, because that's what I would do. That's why sometimes I only go for 100 pips, even though maybe I should be going for 300 pips, because I want to cover the spread. So if the spread is wide, like right now, Asia session, the spread is about 140 pips on my FTMO right now. So instead of going for 150 pips, I will just go for 100 pips, so that I can at least lock in my profit. Because and I'm sure you've seen before where it gets past your TP and it doesn't trigger it.
Yeah, many times.
And then you get upset because it reverses, and you're like, oh, what happened to my trade? Yeah.
Super valuable stuff, man. So I guess we went a bit off track, but just like when to exit something when you think, hey, this ain't good. But I guess that only really applies when you're doing a V3 for 300 pips. I mean, it seems less and less appealing to go for that many pips now, especially with the spread and the risk of it reversing. But if it's just a quick 100, I might just focus on that, and maybe I don't need to start thinking about exiting trades and stuff. Is it something you personally would ever close out early, or do you just commit to it and leave it?
I usually don't close out early if it's 100 pips. If it's anything more than 100 pips, then in some instances, I would close out early. So for example, like today, I don't think we have a bias right now. So for me, or actually we do have a bias now, it's actually 60%, which is perfect. This is what we were waiting for this whole week. Like I was waiting for it.
I saw it. Yeah.
Yeah. So say, for example, there's no bias and it's 50-50 like it was this morning. If I get an opposite variation, so say, for example, we have a variation for a sell, and then we have an opposite variation. Let me see if I could find one here. So there's a variation here for a sell. I just want to see if there's an opposite. Okay, so just say, for example, I know we don't have an entry. Actually, no, we don't. So say we have a variation for a sell here, and then we have an opposite. I'm looking for like another variation in the opposite direction. So no, not that there. This is where I would maybe close out early. So say we have a variation version 3, and then we end up getting an opposite variation. I don't think we're gonna find one
Oh,
here.
I'm with you, right? Yeah, I get what you're saying. It's like it's setting up the other way, basically.
Exactly. Yeah. So
Yeah,
like, for example, here we have like a variation going down, but then say we have like something like this pops up and a
yeah,
variation V1. So we already have a V3 here. You're in profit, and then you see this variation V3, V1 come because it's a double body. Then I would close out in profit down here halfway.
definitely. That seems, yeah,
That's probably the main time when I would do it. The only other time I would close out early is if I'm getting close to a sessions, news price, opening price, basically any horizontal line that you draw on the chart. That's where I would pull out early because it's kind of giving you it's increasing your risk because the odds of it retracing or reversing on you is like 50-50. You're kind of gambling at that point.
Sean, does it make sense? Like I kind of, again, it's not gospel, but just from what I've noticed and had a bit of success with, I was seeing that 15 and 15 was kind of a good stop loss and a good take profit size in London when it's opened and it's moving. So if I'm going for 100 pips, if I start to try and take some of these moves, what should I have? Does it make sense to go for a 5 point move? Like it just add the spread on and have to go down. I'm basically saying, should I halve the 100 to 50 as I've halved the?
Oh, so you want to subtract your TP by 50, basically.
Like half it. I've noticed like the V3s I've taken in London, I've had them half so it's 300 and 300 K2 recommended in New York. But the ones I've been having are 150 and 150. So if I'm going for a V1, which is a 300 stop loss and 100 take profit, am I cool to like go for a 150 stop loss and a 50 take profit? That makes sense to do that, doesn't it? It's just going to take longer to hit it with the spread, right? It's not going to like do anything weird because it's such a low amount of pips.
Yeah. The problem with cutting your stop loss in half is that you also have to factor the spread in for that too. So say, for example, like you were mentioning, let me just put, so say, for example, you're mentioning like you were saying to cut the stop loss in half, right? So like you wanted to do something like this, right? Where it was 150 pip stop loss and 100 pip TP. Is that what you're referring to?
Yeah, I mean, just when I've been putting the stop loss above the high in a sell, it's been around 150 pips. So I guess if I'm now going to move into not just V3s tomorrow, I'm going to look for V1. So essentially, I'm going for way less. I'm going for a third the amount of pips for my take profit. Should I halve the requirements for New York, like I've halved them from 300 to 300 to 150 to 150 for a V3? If I'm going for a V1, I guess then though, if I keep the stop loss big, like you said, it's going to be like a tiny risk to reward, isn't it? I don't know.
Yeah, the risk reward isn't the best, but the reason why I would still recommend having a wider stop loss is because if your spread is pretty high, like during Asia session, it's 140, you would go into automatic drawdown. So like say you're in there at some point right here, you're already in drawdown like that much.
Yeah.
So if it pushes up even a little bit in the negative, you'll just get automatically stopped out.
What do you think I should go for then, Sean, based on those? If I'm trading London, or do you think I should avoid it with such tight? What do you think I should try and look for as a good benchmark? If you know of any data from previous done well.
So from like Kevin in the group, he still uses the same, he actually uses like a wider stop loss. He just looks for like a strong direction of price, and he'll have a really wide stop loss. He actually goes wider than what I do. I typically put about 300 pips because I like to have, I don't want it to be too wide because, if you lose a trade, you're going to be in a deep hole. He actually makes his even wider. So he sets he'll take trades like this, which I don't necessarily recommend, but he's trading in his own personal account. So it's different. He doesn't have the requirements there. So he takes trades like this, but all of his trades will almost always hit TP.
Yeah, I'm not Kevin, Sean. I need to be careful here. I'm 50% down on the challenge. I'm under pressure here. Kevin's
no.
He can do what he wants.
Same here. I can't do that because it's too risky because if you have one loss, then
it's going to take you like 15 wins to catch up, isn't it?
Exactly. Yeah. So I would never do that. I would still keep it around 300. I mean, it depends on your spread. If the spread is tighter, so right now I'm looking at the spread. The spread's about 220 pips. you have to take that into consideration. So if the spread is 220 pips, I would do, you would at least have to have at least 300, because when you enter this trade here, you're going to be entering at a negative at that point, 220 pips.
Right, this is super important. Yeah. So basically, I'll eye up the spread. If I see it's either 14 or 17. They're the two numbers I've noticed when I've been looking at London.
Yeah, if it's around that point, then I would probably just keep it at 30 or 300. The only problem is because if you have let me see if I can find. Let me go back to London session. Let's see if we could find.
Basically, I'll just keep it up what the requirements are from the K2 strategy. Then basically the same, because I'm not going for a full-on V3 now. I'm going to probably win more, aren't I? And I'm reading higher time frames and stuff, taking all that in. So if I can see a good push, like a good candle breaking its own low or something on a higher time frame, then I can be confident that it's going to hit that move, right?
Yeah, no, definitely. I would agree. So like, for example, I think there's one right here. This is that's not Asia. I mean, that's Asia session, not London. London was, okay, it's over here. So let me just rewind over here and see if we could find anything. I think there's like a double body right here. So here's one, or this isn't London. This is a London session. There is
I look at the trades after midnight your time. So midnight PST is 8 a.m. for me. I find it very similar to the breakouts that we trade. It does a big push.
Oh yeah. Yeah, I think it's pretty risky between that period. Like you can see here on London Open, this huge candle.
No, I let it settle down, and then once the direction's established and the futures points are 100, I kind of can read what's going on and then look for some little entries.
Yeah, exactly. Typically, when I used to trade London session, I used to stay up and just trade London session. I would wait after the first hour or 2 hours. So if you were to draw, so I'll draw it here. This is London Open midnight, and then I will draw 2 hours later, and then I'll draw up until the. I'll just take a lot of these things off so I can clean up the chart so that you can see things a lot better. Okay, so we have this until New York Open, and you'll see that the market starts to move a lot smoother after the first 2 hours. So the first 2 hours, you get like this crazy movement, price spikes up. It's like the breakout. It'll spike up, come back down, consolidate. And then once it reaches 2 hours into the market, you'll start to see that price starts to move a lot smoother. See that?
Yeah, I hadn't noticed that. I'd convinced myself that it starts dying off, probably because I'm just new to this and like seeing, I think that it's dying off, but yeah, okay. So that's when you'd look for the nice setups when it's calmed down, and then obviously with the look for a good bias.
Exactly. Yeah. Yeah. Because typically like you'll have this crazy movement because it's going to be a lot of fake outs on open, because you'll have a lot of, traders from the London market entering the market. So you'll see some manipulation up to the downside, and then it'll consolidate a bit before it actually chooses its direction for the day. So you can see right here, it did drop initially, and then it started to shift the other direction.
I do like this sort of time as well, because there's usually no US news on around. So I'm not like thinking, damn, I've got 7 minutes till there's news and then have to mark the news price up. I've been getting like, it's kind of taken that element out a bit, but I don't know. I think I just keep testing it. And at this point, if it's 2 hours after the open, I'm only a few hours more until New York. So I guess I'll just keep seeing how it goes. How did it go for you when you traded London with US 30? Were you doing the 1 minute and you just found that you'd wait 2 hours and then you'd get the better moves?
Yeah, typically I would trade the 1 minute and the 5 minute and 10 minute. So I would trade US 30. I would also trade the DAX. I don't know, have you traded the DAX before?
Yeah, I went on DAX 40 yesterday actually and won a trade on it. I found it moving so similarly to US 30 that I just thought I'll just stick with US 30. They would literally
it's the same thing. Yeah, it mirrors US 30. I think it's the same assets. It's just that they added another 10. Last year it used to be DAX 30. Now it's DAX 40.
Does Euro news affect DAX 30? Because obviously there's no US news going on at that time. Now I'm looking at the calendar. Is it like German companies in the DAX? Like
yes, that's correct. Yeah,
so
it's German.
Euro news will rocket around everywhere.
Yeah, definitely. Yeah, that's why like I think there was Euro news right here. Maybe you can check the news from today. Typically, it's the same thing, just European companies. So 29th. I think the biggest thing here was so like ECB President Lagarde speaks, and then also the G7 meeting. So this was going on as well around that
Does that
same
affect
time.
US? Does that affect US 30, Sean? If I'm like, if it's affecting DAX and they move so similarly, then does high impact Euro news? Would I mark that up on the chart and avoid trading around it in the London
I,
session?
yeah, I personally would because it's similar companies. Like a lot of these companies that are in the US, they have their subsidiaries in Europe as well. So it's going to affect any type of news will affect the market. I think the G7 meeting here, this is like something that affects pretty much all markets. It's basically the financial meeting between seven of the industrialized nations like Canada, Italy, France, Germany, Japan, UK, US. So it affects pretty much all assets, the entire forex market, and then in turn that'll affect the stocks within the company because they're all discussing the economy of each country, the economy of the world in general. Since we're all kind of going into a recession, it's going to affect all the markets altogether. So yeah, I would mark it up just in case.
Yeah.
It's better to be safe than taking these risks, and that's the way that I trade. That's why for me I'm very consistent because um, I don't just take like any trade. I typically wait for like the very best trade, and then I'll take maybe one or two trades, and that's about it for me.
Percent wise, I know you've got some accounts tied together, so I don't start like overshooting trying to do what I don't want to do is take like 10, 12 trades. I'd rather take one or two a day. I much prefer that.
Yeah,
You aim for a certain percent, Sean, like 1% or something like that, or do you just see what you get given?
yeah, somewhere around. Well, I don't have a goal, but typically, each trade I'm going for maybe 1% or 0.5%. Because
So
if
you're
I'm
really
doing,
three to
yeah,
get one in most cases.
yeah, most cases it's one, and it's fine because since I have multiple 200K accounts, 200,000 or yeah, 200,000 times 1% is 2,000. So it's
Yeah,
typically I'm doing like about 1,000. Usually, sometimes it's between 1,000, 2,000 around there. But then you multiply that by five accounts, like 10,000 total.
yeah,
So
yeah, makes sense.
yeah, and this is how I would probably recommend because this you're kind of spreading your risk across the accounts instead of taking like 5% risk on one account, and then odds of you blowing that account is higher rather than risking just 1% or so.
So let's say now I take everything on board, keep strict, maybe go for the 100 points, maybe go do a bit more New York stuff and join the lives. Let's say I make it to my first payout in this 100K account. Um, do you to pass another like my Forex funds challenge? I know we can tie it in with software and stuff to get that 8%. Do you just stick to your original trades and then you're gonna at least make that by trading very conservatively and with the bias and stuff, or do you do anything extra to pass a challenge account um, to make sure you get that percent, or do you just tie it in, take the trades on the main account and let it pass?
Yeah, exactly. That's exactly what I do. So I just take the same trades, and then eventually it'll add up to the point where it passes. Like a lot of the times when I initially started, doing my forex funds, because before I was only on FTMO, when I started doing my forex funds, MFF, I would just take the trades normally, and then I would get the email like, "Hey, you passed." I wouldn't even think about it. I'm like, okay, like it's just the same profits, but you're not really going for a goal. I think that's what really gets to people. Like when you have that mindset where you're trying to pass, you start to get greedy because you want to pass right away. You want to make sure you pass, within that period. But a lot of these companies give you extensions now. So there's no problem with taking your time because you can go, 8% is not that difficult. If you're making 1% per day or even 0.5% per day, you can do that within a month easily if you have, minimal losses or no losses at all. And typically that's what I see with a lot of the members who succeed really well in K2 is that they're in no rush. So they're just taking trades, and then each day they have like a goal of maybe like 1,000, which is like 1% of their account. And then it just keeps adding up because if you have one good week and you have like just one trade per day, because there's going to be multiple trades. There's going to be like 10, 20, 30 trades that you can possibly take. But if you take one of the very good ones that it actually hits and you just do that every single day, it's less stress. And then at the end of the week, you'll see that it's added up to about 5% or so.
So to do that, you're relying on very, very little losses then, I guess, because one loss will wipe out 3 wins, won't it? And if you're doing one trade a day, you could really
Yeah, depending on if you're mixing the strategy. So if you're just using the V1 and V2 or you're going for 100 pips, then yeah, you would wipe it out if that'd be the case. But if you were to use it in conjunction, which I don't recommend, you should probably focus on just 1 or 2 strategies. For me, if I see like a snipe strategy on the 10-minute, that will cover a lot more because that's going for like 500 pips.
What about the opening, Sean? I mean, I've taken some openings. It's pretty crazy. What is that part of your strategy to take the open, or are you?
Yeah, typically, well, yeah. So if there's a strong bias, then I'll take the opening for the full move. If there is not a strong bias or no bias, I may take the opening, but just take it for partial move. Like today, it was a full TP, but I only took it for 100 pips because I wasn't fully confident. And that's how I always like recommend how people trade. Like if you're confident about the position, then ride it the full way. But if you're not, then just pull out because it's better to have some profit than a loss. Because in a lot of instances, some people will just take the trade and think that it's automatic. A lot of instances, it's like you don't know because the market's going to be moving a bit crazy. Like tomorrow, I think tomorrow might be a bit crazy because we have a lot of U.S. news. We have the OPEC meetings all day. We have Fed member. So basically, the Fed's speaking all day tomorrow. Tomorrow's a Fed day. So the Fed is going to be covering, the U.S. economy. It's going to affect the market pretty heavily, especially with Powell speaking at 6 o'clock. So tomorrow I might not even take any trades, or I might take something, but I'm going to go for only 100 pips because it's going to be very erratic tomorrow. That's what I can see from the market.
Yeah, got it. Well, I've got some fantastic notes, Sean, and like super actionable stuff. I think I've got a few things to think about now, and I don't really have any other questions. I've got a great plan, and that's it, man. Thank you.
Yeah, no, definitely. Yeah, I think initially maybe you'd probably be better off taking the 100 pips to build your confidence, because once you build your confidence, then you'll be more trusting of like the V3s and going for the bigger moves. Typically that's how it is with a lot of people. They'll take just like 100 pips, like how I'm doing, just to build confidence. And then once they're very confident, then they can start taking the bigger moves.
Yeah, that's great advice. That's exactly what I plan on doing. Yeah, thank you. I'll see you on the live tomorrow. Thanks, Sean.
Yeah, no problem, Peter. So I'll see you tomorrow then.
Sean, is this going to be recorded? I'm going to send it over to my friend who's joined. He's trading similarly to me, so I'm going to fire it over to him.
Yeah, I'll send you over the link right